Thank you and welcome to another session in financial literacy. Today we're going to be talking about life insurance and the importance of it, but how it actually works. So think to yourself as we're going through this, which would you prefer? All right. So the first one is in Bank A. Now Bank A has life insurance and they also have the investment and it's bundled together. So one policy bundled together into one, right? So what happens there is that when you bundle life insurance with an investment or a cash value or a savings, the company actually can keep that money, the savings portion, up to the first 2 to 5 years or more. So you're not really making anything in your savings portion. And when you do start making money, it's not even keeping up with inflation because they're only going to give you a 1 to 4% return on your money. Now, also, here's another thing, is that the money that you've saved over the years, what if you need to take it for an emergency? Or maybe you want to go on a vacation. The company will actually make you borrow your own money. And when you borrow something, what comes with it? You got it, a loan. So they're going to charge you 6 to 8% to borrow your own money. The other thing that happens is that when you say you want some of your money, the company, again, they can keep it up to another 6 months before they even give it to you. So think about it. Why do you think they're doing that? You guessed it, is because they want to make more money. They're investing your money. They're making money off of you. The other thing that's really terrible about this is that when you die, your beneficiaries do not get the savings portion in that account. They don't get what you've been saving all those years. The company keeps it. They're only going to pay out the death benefit. So think about this. Why would you be in a vehicle where you don't have access to your own money unless you borrow it, and then upon death, your beneficiaries don't even get it? Okay, so that's how Bank A works. And remember, the reason why it works that way is because the life insurance and the investment are bundled together. That's the key. You never, ever, ever should put life insurance with investments together. All right, so that's how Bank A works. So now we're going to take a look at Bank B. So Bank B says, we're going to separate it. We're going to give you an opportunity to have an investment where your investment is going to grow for you at an alarming rate. And guess what? Your money is accredited to you immediately. So if you need it, it's available. They're going to give you a 7% or more return on your money. You can't even find that in the bank. Another thing that's to your benefit is there's no fees to withdraw your money. Remember, you go to the bank and you take money out, they don't charge you a fee to take money out of your savings account. It's available to you. It's your money. Why should you have to pay a fee to get your own money? There's no borrowing here, right? So also it's available to you within 24 to 48 hours. Perfect thing right here is what's exciting is that upon death, the beneficiary is going to get the investment portion, because remember, they're not bundled, they're separate. They're going to get the investment. They're also going to get the death benefit or the life insurance. So it's a win-win. They get both. So if you compare Bank A with Bank B, all right, so Bank A is what we call a cash value life insurance policy, or a whole life, or a universal, or a variable. They're all the same. That's how they work. They just change the name. So if you look at cash value life insurance and you see all the penalties that are associated with it, then if you look at a pure term life insurance policy, number one is 8 to 10 times cheaper than a cash value. So your family can actually get more in life insurance with a pure term life insurance. So you think about your car insurance, it's strictly car insurance. You don't have any kind of bundling with that, with savings or investments or anything. That's how your life insurance should be. So when you just have pure life insurance, you get all the benefits of Bank B because your investment is a separate entity from your life insurance. They're not bundled together. So that's why we say buy term life insurance and invest the difference. All right. So here's the question for you. Which do you prefer? Now that you understand how life insurance works, which would you prefer? Would you prefer Bank A, where it's bundled together, when you've got all these penalties, and Upon death, the company's going to keep your money. That's the key. They're going to keep it. Or would you prefer Bank B, where you have a pure life insurance plan? Your investment is separate. The investments is working for you while you have your life insurance, and then you get all these benefits. So here's the thing that we want you to understand is that life insurance is only for your immediate need while you're building your wealth. It should not be for your entire life. It's only while you're building your wealth. So if the plan is put together properly, then we help you to actually get out of the life insurance. You no longer need it because you're self-insured. Okay, so I hope that makes sense. I hope you understand now. Which do you prefer, Bank A or Bank B? I thank you very much for joining me today. Hope you learned something, and I look forward to seeing you on the next time. All right, take care. God bless you.